Welcome to the Value Investor TV podcast. This is the podcast that helps you grow your wealth and become financially independent. My name is Becco and my partner, Hari.
Hello.
Today we will be talking about, as you guys saw in the title, kind of deeper dive into return on equity and why it matters to us, how we should think about it for different industries. We should definitely take that into account when we're looking at any numbers, but specifically for return on equity, and maybe generally, why this ratio is so important, along with other kind of operational efficiency ratios such as return on invested capital, and so on and so forth. So before we start, though, Hari, please give us a little quick disclaimer.
Yeah, so this podcast is designed to help you invest the way that value investors would invest, and we are trying to teach you how they would do that. So this is an educational podcast. We are not making specific recommendations since we don't know your specific financial situation. So in the event that you are making any financial decisions, if you feel the need, then contact a financial advisor.
Awesome. All right, let's dive right into this podcast, guys. So like we talked about earlier, so this episode is going to be on return on equity, sometimes shortened for ROE. This is so important for value investors because it kind of tells you how efficient the companies are in putting the money back into the business to grow. Because ultimately, as shareholders, we are really looking for shareholder return in a long term. So return on equity is a good way to kind of measure that. And so, Hari, I think first, maybe take us through why this is so important, and then we could jump into, why this is important, first of all, and secondly, how this could differ for different industries.
Yeah, so we have kind of talked about return on equity several times throughout the podcast, and if you don't understand what that is, I would highly recommend listening to our topics around the ratios, and also about the financial statements around balance sheet, which defines what equity is, and so does the cash flow statements and the net income statements. So the reason that we highlight that is that return on equity is really about how profitable a business is. So during the normal operations of a business, they have to buy assets, and then they use those assets to turn that into ongoing cash, right? They sell a product, the product gets converted into first into goods, then it gets sold, and then that becomes cash, right? That's a cycle that it goes through in order to in the normal life cycle of a business. In that process, the more profitable a business is, the better they are able to expand that profitability into the next thing. So, for example, you have a business that takes $100 in assets, in equity, let's call it, instead, and it generates $15 in income every year. So that's a 15% return on equity. So that $15 now is a decision that the company has to make as to what should we do with that $15, right? We can invest it in the business, which means we're hiring more people and buying more assets, right? So that $15 goes into becomes $115 in equity, and now they can get 15% on $115 in equity, right? Think about a business like a restaurant chain, right? Every restaurant that they open, you can't, if you have a restaurant in Albuquerque, New Mexico, it doesn't really benefit anybody in, Schenectady, New York, right? You have to have those assets near the people to make, money off of it. So the return on equity here, you can grow your business by buying more assets. That gets converted into something that you can sell, and that's how you continue to do this. So if you imagine, though, in the case that we have a business that has a 7.5% return, right? So instead of making $15, they return $7. Well, that equity now goes from $100 to $107, right? So in 5 years, a business that had 15% return on equity would be able to double its equity base and then grow, by selling assets that way. Whereas one that would get 7% return actually would take 10 years roughly to double its equity base, right? So you can see here that by growing your equity base, you're able to sell more product, right? That is kind of the goal of every company, is to be able to, in terms of growth, right? So we talk about the type of investing that we've been talking about is this great businesses at a fair price, or, good stocks cheap, as another way of saying it. So when we look at businesses, we want to see, do they have a long runway for growth? That was part of our checklist. And if they have that long runway for growth, can they invest that money back into the business, right? So that's kind of what we are trying to get into. So I've said a lot of things already. So maybe Becca, if you want to jump in and do you have anything to add there?
Yeah, I think when I first kind of learned about these operational efficiency ratios, I think a good way to think about it is like gallons per mile. The gallons per mile, I think it's a good kind of analogy, because let's say you have a car that's just burning fuel, and for 1 gallon or 1 liter of gasoline, how far can the car go? I think it's a good way to think about it. I think it's a similar analogy in that it's really talking about how efficiently can an entity, be it a car or be it an organization or company, how efficiently can they use the resources at hand to go far? So I think for me, kind of an easy way to think about it was that I know when we were younger and taking physics class or kind of science class, and we would kind of think about the efficiency ratios for combustion engine, for example. You can never go up 50%, for example, for combustion engine, things like that. I think that is kind of the mental framework that I use to understand these operational efficiency ratio, namely return on equity and return on invested capital, return on capital employed, all these different ratios. You think of it that way, at least for me. I think that really helped. Anything you want to add there, Hari?
Yeah, no, I think that's kind of the purpose of this, is measuring how profitable a business is, right? So in that example that I was giving, there was a 15% return versus a 7% return. Well, if I have that business, right, the one that's more efficient, that's able to generate more income per dollar spent, right, then I am looking for the businesses that can maximize that kind of return, right? Because then what'll happen is they can compound their money faster, right? For every dollar they invest, they can get 15%. It only takes 5 years for them to double versus the company that gets 7% return, right?
Yeah.
So why this is so critical is your rate of return for the stock is basically how, the return on equity for the business, right? In a business that will reinvest all of its money back into the business. Okay? So I want to reiterate that, because that's such a fundamental concept and such an important, part of what we do, is the return on equity for a business will roughly equate to the long-term returns for an investor in that business.
Yep.
So
if I could, go ahead.
And that's only assuming that the business reinvests all of its profits back into the company. Okay, so if it's paying dividends and if it's doing stock buybacks, right, that money that it's generating is not going back into the company. It's being returned to shareholders. So that return won't be. So we're talking about only businesses that are reinvesting their profits back into the company.
Yeah. So it's good kind of. So maybe I think a good way to kind of start. I know we were kind of 10 minutes in already on the podcast, but I think a good way to kind of think about this is to first define what return on equity is, because I don't think we really defined it up front. So what is return? How do you calculate return on equity? I think that is a good kind of segue into this topic. How do you, what's the equation?
Yeah, so it's net income, which is at the bottom of the income statement, the bottom line, as it were, and the equity is actually the assets minus liability. So what you own, which is the assets, what you owe is the liability, and equity is the difference between those two. So companies that have a asset-heavy business, right? They have to buy a lot of equipment and assets in order to run the business. Is kind of what we're talking about in the traditional sense, right? Most businesses prior to technology businesses were asset-heavy businesses, so they had to spend a lot of money to acquire the assets and then use that to generate income.
Mm-hmm.
So those heavy businesses, there's two parts of this equation, right? The top part is net income, right, which is affected by, the price of the goods sold, and and it is also affected by the operating profit, so which is how much money is spent on employees and things like that. It's on research and development, and sales and marketing affect that number. And then the equity is actually affected by how many assets that you buy. So that are going to be used for more than 1 year in a company. So think of cars, think of the plants that you have to invest in. Think of the buildings that house everybody that works at the company, that kind of stuff, right? So it's pretty easy to see how these levers can kind of be played out, right? So if I am starting a company, let's say that we sell tacos, right? So if I spend a lot of money on employees, right? So I'm going to lower my net income because I'm increasing my operating expenses, so my employee expenses. Let's say I have a heavy marketing budget, that'll also lower my net income. And then if I buy real estate in very expensive parts of town, that will increase my asset base, which will actually lower my net income, right? So then the one thing that will lower my equity. The one trick about this is, we said it's assets minus liabilities. If you increase your liability amount, then you will decrease your equity base, which will artificially increase your return on equity, right? So, So what we try and do is, when we're making this calculation, we're using it in the context of a business that is not overly leveraged, right? So that means that they're not, they don't have a ton of debt. So there's the debt to equity ratio is less than 1 in some cases, is a good measurement for that. Or another way to measure that is that free cash flow can pay off their debt in 3 years. So, go ahead, Becco.
Yeah, on that, because there's kind of quite a bit of stuff to unpack there. If I could kind of summarize for our audience. So return on equity, again, is calculated by this very simple equation. This is just division. Simple, two numbers, take two numbers and divide them. And that's how you get return on equity. And the first number on the top is the bottom line. So the net income. So you can see this in the income statement. The bottom of the income statement, you'll be able to find that number. The number on the bottom, the number that you divide with, is the equity, which is located in the balance sheet. So you take those two numbers and divide. That's how you get return on equity. And what Hardy's talking about in terms of the debt load is that because we are using equity as the denominator, if the denominator itself is very small, the return on equity number, is going to be artificially big. So sometimes you have to look at the context of their balance sheet to figure out if the return on equity number is artificially high because of a high debt load. So that's why you have to look at other measurements of healthy balance sheets, such as debt to equity ratio, for example. That's what Hardy is talking about there.
Yeah, and for there are other return on invested capital, return on common equity. There's lots of different terms that are measuring kind of the same thing, and there's little different ways to calculate it. For the purpose of this discussion, let's just focus on return on equity as a blanket term for the profitability metrics, because what we're trying to teach you is this slightly more advanced concept, right? Which is the money that I get off of this return, right? That money is what I want to maximize that without having a lot of debt, right? Because what that will, and what that tells me is I can take that money and reinvest it back in the business, right? And if I'm reinvesting it back in the business, I'm going to take that money. I want to have as much of that as possible because that's how I can grow my business quickly, right? If I have a very low return on equity, then my incremental dollars spent back in the business don't really benefit me very much, right? And if I have a high return on equity, then I want to put all of my money back in, right? So why this is such a critical concept and why we've been talking about it and dedicating a whole episode to it is, as I said before, the long-term rate of return for any investment will mirror what the return on equity is, right? And so if you put your money back into the business, you're going to see that asset base grow, and then that money will then get converted into long-term returns, right? So we're talking not 1 year, not 2 years, but probably more like 5 years. You will see that rate of return mirror what the return on equity is. So the good thing is, if you find a great business, and you know it's a great business because you've gone through our checklist, which you can get from us at info@valueinvestor.org, or you can tweet us at Value Investor TV to get that from us. You will walk through and you will identify this is a great business. You can kind of pre-predict what your rate of return will be for that business over a long period of time, right?
Yeah.
That's an amazing concept to me, right? That I can tell you 5 years from now, because I know that this business will continue to operate the way it's operating right now. It'll just be, have grown by the number of years times the return on equity that I've seen, right?
Yeah. So on that note, I just want to kind of touch on this because this is a very powerful concept, like Hari talked about. And also, this is a concept that we just didn't discover. This is a concept that many really good investors out there have been kind of preaching for a long time, namely Charlie Munger. If you want to kind of touch on that point, Hari, briefly.
I don't know if you can see behind me. There's a blue book. It's called Poor Charlie's Almanac, and it's the tall one there. It's a little blurry because of the way the camera works, but so. Poor Charlie's Almanac is a book you can buy on Amazon, and it's well worth the investment because what he does in that book is he kind of gives several lectures that he has transcriptions from to law school classes to business school classes, and he kind of expounds on this concept of buying great businesses, and he also kind of talks about I'm buying a great business. But he talks about what makes a great business great, which is that return on equity concept, right? So being able to take the money out of the business, reinvest it back, or taking money from the income of the business and reinvesting it back to allow it to grow over time, right? So that's a really powerful concept that I had, for the first time really learned about when reading Poor Charlie's Almanac. So if you don't have a copy, I would highly recommend picking one up on Amazon. We will post a link to it in our on the YouTube video, and we'll probably tweet it out as well in case people are looking for it. Or you can send us an email and we can send you a link too. But well worth the read, and it's an expensive book, but it's one of those that you'll read. You can read every year for the rest of your life and still gain insights, from. So,
yeah. Again, kind of going back to my original point, this is a very, very important concept for value investors. To kind of, as value investors, we want to invest long term, and this is a really good way to figure out which companies will be a great investment for long term portfolio. Let's see. Kind of on that note, I think what we could do is move on to our next episode to end it here. And then in the next episode, we will be talking about kind of how return on equity. We have to think about return on equity slightly differently for asset light business. How does that sound, Hari?
Yeah, I mean, just to give you a preview of that we had talked about the top line and the bottom line of the equation, and so with businesses that have asset heavy models, think of a railroad company that has to constantly upgrade their tracks and their trains and things like that. Relative to that, their equity base is purely kind of drives their return. Now, think about it from a perspective of a technical company, right? Like a Google or a Facebook or something where, they don't have as many assets. So, some concepts that we can go over in the next episode, I think well worth your time to listen to, because honestly, this is probably the most important concept you will ever, you need to understand in investing. And just one more thing, before we close.
Sure.
There's a great book also called The 100 Baggers, right? It is a book that looked at all of the companies that had 100x return on your investment from, any arbitrary period to, that 100x return. And they tried to find what are the common parameters that make up that 100-bagger business, right? And the interesting thing about it is all of those businesses had very high return on equity, 15% or higher. And, if you look at it, the businesses that got to the 100-bagger faster got there because they had a higher return on equity, right? So if you have a 25% return on equity, you'll probably get there in about 10 years. Or I'm sorry, in 20 years. Whereas if you have a 15% return on equity, it's going to take you closer to 40 years to get there. So, it's actually a little more than 40 years to get there. So, that higher return that you can get on your equity base, the higher and faster your business will grow, and the faster that. So, another book that we'll tweet out and also link in the on the YouTube channel.
Yep, those are really good, really great book recommendation. One, Poor Charlie Almanac, we'll tweet that out and we'll put it in the description box. And the second book that I talked about right there is 100 Baggers, another great book for value investors. So kind of that's it for us right now for this episode, but stay tuned because the next concept that we'll be talking about is really a powerful concept. I think it's a concept that will help you become a much, much better value investor, especially in the context of all these great kind of asset-light businesses that we have to kind of deal with and analyze as value investor in this era. So stay tuned. Thank you guys for listening.
Thanks.